Welcome to TheoTrade. This is Don Kaufman. April 22nd, 2022. There are 9 minutes left inside of the trading week. Dramatic sell-side activity creating all types of opportunities in this marketplace. Again, there are literally moments to go, and the selling, it's becoming, well, dynamically downright ugly. Let me actually start off this weekend's update with precisely what that statement means. When I'm talking about the dynamics of the marketplace, or, in this case, just downright hideous sell-side activity, you've actually got to deviate and look over at the SPX, the mother of all products. One of the first things I'm going to tell you about this in terms of the SPX, listen, it is just downright, it is getting real out there and real in a hurry. Forget the fact that the S&Ps are down almost 3%, because I'm going to tell you right now, on a percentage move and a percentage basis, that to me is not of like wild significance. Oh, it's a 3% move. Anything that's a 3% move or more would be quote unquote statistically significant, but quite frankly, that's not the move that has me interested. It's the move and the fact that we were literally to a T to the upper edge of the expected move on Thursday, reverse course, gotten slammed, and now we're starting to dynamically hedge outside of the lower edge of the SPX. You've got to look though at this dynamic on an intraday trade, because it is downright wicked. One of the things I talk about each and every time I do one of these evening videos or a weekend update is I talk incessantly about expected move. And if you're not looking at expected move, I'm just telling you right now, you're doing yourself a huge disservice. So I'm actually going to back up and show you the last 3 days of trade. And the reason that I'm going to show you the last 3 days of trade, and again, even with moments to go, I'm going to close up that left side bar. And I want you to see this because your entire trading week came right to the upper edge of the expected move. Now remember, I draw these SPX expected moves, okay, on a Friday for the following Friday, because that's when, products are rolled. But it is all about gamma risk these days. It's all about hedging activity. And it's one of the reasons that the edges of these expected moves are just, insightful. Okay, that's an understatement. Literally on Thursday to a T, we open on the upper edge of the expected move. Okay, we skirt the line. We come off of it hard and fast. This is the zero barrier. It's the starting place for the week. Look where we are right here, right now. Again, there's like moments left inside of the trading week. We're trying to hang on to the lower edge of the expected move. Now, for those of you that do not recall, and again, it's okay if you don't remember, but the expected move, okay, of this week was plus 98 or minus 98. And I have to tell you, I can count pretty much on one hand the number of times I've actually seen upper edge hit and breached one day, lower edge hit and breached the very next day. The issue that is at hand here, and again, with 5 minutes left inside of the trading day, it's the most pivotal move right now. We're starting to push off the lower edge of the expected move, which happens to be, that lower edge is right at, again, and I'm going to label this 42.95. When I say we're pushing off of it, the moment you get outside of the edge of that expected move, dealers, which are market makers, actually have to hedge in the dynamic of the marketplace. So in effect, they have to sell into selling. So as the market starts to sell off, they'll actually push it. And again, on a day like today, you just cannot have that bell go off fast enough. But I wanted to start with that because, people, this is the trade. This is what is, it's imperative to understand, because never before have we seen expected move with this, okay, incredible degree of efficiency in the overall marketplace. And it looks like, again, with just moments left inside of the entire trading week, that net, we are actually going to close outside of the expected move. This would actually be the second week in a row. As I'm saying, it is getting real out there, even with like a 3% move. But you got to, rationalize the fact that you're down from a high to a low yesterday to the tune of what, over 2%, another 3% decline today. The way I look at it, this is starting to add up. All right. In the kind of market update, before we really start to talk in quite some depth about what have really become phenomenal opportunities in this marketplace. And again, it just cracked wide open in the last 24 hours. All right. First and foremost, in the market update, you got to come right down here. Correlation coefficient. Again, if you've ever heard me do an update anytime recently, okay, think about this. You can go back to Wednesday. You can go back to last weekend's video. Everything I'm talking about right now is right here. It's the correlation coefficient. And the reason that I'm talking about correlation so heavily inside of the S&P 100 is, for the most part, this was the sign that we were coming out of a slopfest marketplace, and it was there, and it was actually there on Wednesday. But the irony was that on Wednesday, that the correlation was almost completely to the upside. We actually at one point had like over 87 products trading to the upside, which is full-blown correlation to the upside. But I cautioned, I said to you, literally on Wednesday, the risk is to the downside. That if we were actually going to trade to the upside, and again, I'd like to be extremely just crystal clear on this one, but on Wednesday we were saying like, hey, if we're going to come to the upside, we're going to hit the upper edge of the expected move, probably skirt it, but if we come off, it could be downright hideous. Well, hideous, here we are. All right, so we actually hit the upper edge of the expected move. We hit the lower edge of the expected move. As I said, you can count the number of times that has occurred. You can go back and look through history. I mean, I've got years. In fact, I can go back, it's in a weekly, but I can even go back as many as 5 years. I actually have expected moves now back a full 5 years. And again, on one hand, you can count the number of breaches to the upside and the downside in the exact, same week. But this is one trading session versus another trading session, which again, there is phenomenal volatility. Okay, correlation makes a comeback. Next on here, when we're talking about volatility, well, let's bring it up. A lot of people would look at something like the VIX. So the S&P 500 volatility index is raging right now, up some about 23%. But I got to tell you, that is not what is on my mind. See the VIX actually explode up to the 28 level? That's not what's on my mind. What is on my mind, though, is the fact that the volatility futures have also taken off to the upside. But I'm going to give you almost, if you will, kind of a hostile look at markets. And when I say a hostile look, I don't mean to freak anybody out, but we didn't even flip into backwardation yet. So if you look at the May versus, for instance, June, now this is complete and total geek stuff. Look where they are. May is actually sitting at 28, and June is sitting at 28.10. Okay, so the vol futures have actually flattened out. Yesterday, the differential between these was $1.15. Today, it's down to 10 cents. Let me give you the scary part of that. They haven't inverted yet, which means, it's on right now. It is very much on. With 40 seconds left to go in the trading week, it's on in terms of sell-side activity, but you haven't even seen the volatility inversion yet. And the volatility inversion is when May starts to exceed, the June. When May starts to exceed June and volatility flips over. All right, the way that trading firms would hedge that is to actually sell S&P futures. And I got to be very forthright. It's only after you see the volatility flip over that it's like, duck and cover. That's when you want to get under the desk, because that's when things can get serious. And even with the sell side activity that we're seeing today, I'm going to tell you right now, there are numerous examples that I can give you right here. There is the closing bell, and not a second too soon. But I can give you numerous reasons why. People, you haven't seen a bottom here. You haven't seen anything close to a bottom. This is 2 days of sell-side activity from a reversal yesterday. But the volatility futures, they got to invert. They got to go into what we term backwardation. That is, the 26-day Mays have to really start to exceed the Junes. And we saw that considerably early on in the year. Take it a step further in terms of volatility. Look at the VVIX. The VVIX, it is on fire. But again, it's only in the 122 kind of handle. How come it's not raging like it was earlier in the year? I'm going to tell you exactly why it's not raging. It's not raging like earlier in the year because I've seen this movie before, and so have you. When I say that in that particular phrase, and I use it all the time, look, we're coming back down to maybe 42.11. We'll reassess after that. But again, I think you have to anticipate at this point, we're not only going to hit the 42.11, but we may actually have to retest some of the recent lows. Okay, now, We went through a little bit of volatility. We talked, incessantly about like expected move and the dynamic hedge that's actually playing out in this marketplace. As I said, volatility exploding back in the scenes. Here's one, though, that's a little bit off the beaten path that I've got to point out. I'd be remiss not to point this out. Volume inside of the S&P futures throughout the course of this sell-off today was incredibly light. Incredibly light. It's actually worrisome. Again, there's not a lot of liquidity. There's not a lot of activity. You would think that algorithms would have been popping off like just, wildly today. But at the exact same time, I'm saying that, again, we just saw the bell a minute ago. We did about 1.8 million contracts. The point to be made with this, right? Look at some really big trading sessions. I'm talking, wicked stuff when you actually had reactionary lows here in early January and was clear up over 3.5 million contracts. I mean, the bottom line is, does this look like capitulation to you? That's why I threw it in there, because I'm just going to point out capitulation is nowhere to be found over here. Again, the volume of the SPUZ to me is incredibly light versus some of the activity that we just saw. So yes, I'm looking at spiders, but again, you bring this up over like here, let's bring it up over a 3-year. Okay, like, is volume elevated? Yeah. But is this elevated like, some kind of wicked sell-off? Not even close. And that's the point I'm trying to make in here, is right now we're at the forefront of a volatility move. Last but not least, in the market update, the Fed is officially against the markets. Hey, listen, that's their statements, not necessarily mine. Do they come right out and say, I'm against the markets? Of course not. But when Jerome Powell's stepping up and saying 50 basis points looks pretty good at this point, this next FOMC meeting, which is actually coming in early May, yeah, it's going to get real. It's going to get real fast. And that's the one thing you got to realize over here, is that volatility, it's coming. Okay. And it's, and when I say it's coming, you're like, oh, it looks like it's here right now. Listen, this might just be the forefront of it. And that's exactly what I wanted to portray in this particular market update. Now, moving on. Pricing pressures moving forward. I think this is going to be fairly critical. First and foremost, this next week, there's just a packed event calendar. In fact, I'm going to start with that. The packed event calendar. All right. So look at that correlation. All right, that is just crazy. The only thing trading up is Lockheed Martin in the entire S&P 100. All right. Now, packed event calendar. What do I mean by that? All right. Quite simply just that. I mean, pretty much everything under the sun is going to be thrown at the marketplace this particular week. And I'm going to tell you right now, my belief is that tech earnings, which are also going to be, put on your big boy suit, because we're going to be walking into the likes of like Microsoft this next week. I mean, this is the biggest week coming for tech earnings. So, we're not new. Like, we've seen this one before. But with that being said, I think that the tech earnings are going to take a little bit of back seat to the present volatility. You see, the thing with tech earnings is, quite frankly, no one cares. And I'll tell you exactly why they don't care. They don't care because we're correlated. When the correlation really picks up, it's like, oh, look at Tesla, which actually pulled it out, man. It had pretty good earnings, right? Stock actually blew to the upside. Yeah, it's actually down today. And one of the crazy things about Tesla is, the NASDAQ's down almost to the tune of 3%. And Tesla didn't even participate in the sell side activity. I know that makes you feel warm and fuzzy inside, doesn't it? So tech earnings, are they going to have an impact? Of course they're going to have an impact. Of course they're going to move the NASDAQ around, right? But lo and behold, the NASDAQ, this thing is actually facing some of its recent lows. Let's just put, that thought in your mind right now. To get down to the 13,000 level is just one more hideous sell side of a day. You realize that if anybody misses, I think the only thing that matters when it comes to tech earnings right now and pricing pressure moving forward, the only thing that's going to matter is not to the upside. If any of these stocks miss, okay, that's when everybody's going to start to scream. That's right. It is a recession. We are going in at this point. So I wanted to bring up just a handful of products here. One of them is Google. If you will zoom out with me here for a 3-year chart. Why am I bringing up a 3-year chart? This is a humongous breach. Okay. This is a serious technical breakdown. Listen, I am not a market technician. I am a quantitative monkey. This quantitative monkey, though, looks at this 2,500 level inside of Google L. And I'll be specific. This is Google L. That 2,500 level held a lot of weight. Okay, but look at the symmetry of the breach lower. And the irony is, again, this thing has earnings coming out. When? Very soon. Okay, I mean, it's going to have earnings on Tuesday. didn't matter. The market didn't wait. It broke prior to. And Google has been spectacular. Same thing when I say Google's been spectacular. That's around earnings. Same thing actually happened in NVIDIA. NVIDIA has actually cracked through the 200 level. Again, an absolute marquee level. Microsoft, why am I bringing it up? Because Microsoft is right on a pivotal edge. I would say somewhere around that 270 level holds tremendous weight. So again, hands and feet inside of the vehicle at all times. Then, of course, Facebook. I mean, Facebook, I don't know if this is, the edge. I don't know what it is. And we're talking a $184 product, though, that does appear to be continuing to slip. At that point, you got to think about some of the COVID lows, which is like 137. I mean, these are, again, now we're starting to talk about pivotal moves. Now we're starting to talk about underlyings down 45% in the year to date. Okay. Google down 17% year to date. Tesla, okay, unscathed, only down 16%. NVIDIA down 35%. But now let's cruise over to Apple, only down 11%. Now you have to have, again, there's cause for concern. The cause for concern is some of your largest market capitalization, all right, is, of course, it's going to be Apple, and it's only down 11%. It means like institutions, they haven't come in here and just absolutely outright pummeled this marketplace, okay? Most of the stuff is down between 15 and 20% in terms of the big monsters of tech, outside, of course, of Facebook. And yes, we could bring up Netflix, had a spectacular week, only down 64%. Nevertheless, there's a lot of cause for concerns. All right, pricing pressure moving forward. Another aspect that I want to bring to your attention, if you look at bonds, they rallied a little bit. They did. Bonds are in a full-fledged crash. And one of the things that I pointed out, again, on last weekend's video, I talked about, volatility and just getting ready for it because, it's ready to erupt. Well, here we are. A week later, and we're looking at volatility. It's just, again, exploded back onto the scene. But I'm going to give you a different take. So the Fed is clearly right now standing against the marketplace. They're going to lean on us a little bit. And when I say lean on us, I mean tapering the balance sheet, raising interest rates. But you think about all of this. The bonds, I'm actually going to bring up the TNX, which is the interest rate. Okay, I think they've already flown high. But there's actually a weird dynamic that could transpire this next week of trade, and that is this. When you actually see the correlation like this ridiculous and this high, speaking of this ridiculous, take a look at this close, all right? They're not done. This is in the after hours. We're 8 minutes after the closing bell, and they're still selling them. Again, that's the dynamic hedge. You got to sell into selling, and it was, again, as clear as day as we cracked apart inside of the S&Ps. All right. By the way, look at that. Now it's over 3% move. So, backing up over here, as I was taking a look at this, and we'll come out of the SPX, the bond dynamic is an interesting one because what can happen when the correlation picks up in the S&Ps, there's nowhere else to run to. What are they going to do? They're going to just start, let's buy all the volatility we possibly can. Okay, you can see that trade is actually buying the dollar. The dollar's actually broken to the upside. Where else are you going to run to? And the answer is there's nowhere. You may actually see bonds rally back. All right, just think about that, though. Can bonds actually rally back? You better believe they can. You go, but I thought the Fed was going to raise interest rates. But Fed is raising rates. The Fed is raising rates in the short duration. Okay, the longer-term rates, the 10-year, the 30-year, have already exploded. Like, take a look. This is actually the TYX. That's actually the 30-year. Let's clear up and hit 3%. I said to you, like, rates, they've exploded. And again, this is last weekend. I said, rates have exploded. Get ready. All right, there's just no two ways about this. The rates exploding, you knew we're going to break the back of the marketplace. It was just Jerome Powell that just threw a match into the gasoline, and that was it. All right, NASDAQ, by the way, down 410 handles here. Not the biggest move we've seen percentage-wise, but it's, again, we are approaching some of the more recent lows. All right, let's actually get down to it here. Positioning. One of the things that you want to do in this marketplace unequivocally, okay, option premiums, okay, and back month skew, they're on fire. All right, what do I mean by that? If you take a look, wow, the spiders, that's a big move. Okay, if you take a look at the spiders, and I'll use the spiders in this particular instance, and most people are looking at premium, and they're usually, when people are looking to sell option premium, they're usually looking at like VIX, and you're like, okay, VIX is at 28. Yeah, but the back month premium out there is juicy. But what people don't realize is in the back month premium, I don't mind showing you this. I'm going to show you my positions here. Okay, this is the full Monty portion. Take a look. Forget about open interest for a second. Go look at implied volatility out here. Implied volatilities, we're 35 days out. The implied volatility skew, this is actually a hedge that I'm buying 35 days out. I'm buying the hedge. The skew is actually favorable. I'm buying a 27 vol, selling a 29 vol. Knock that out of your head for a second. Then I come out 84 days and I'm unloading and selling some premium out here. You want to know why? I'm in a 40 vol. 40 vol. I don't care. Whoa, the VIX is at 28. I'm selling a 40 vol, and if the market sells off a little bit, bring the pain, because I'm actually going to slip down the volatility skew. The cool thing is the at-the-money puts are trading like a 23.8 vol, but we're selling right now like 40 vol kind of stuff. The skew in the back month options, like 84 days out, is huge by huge. Just huge by huge. And I'm telling you, it is, I routed a lot of positions today. So I'm showing you stuff I did in the spiders, but I don't mind. As I said, everything here is kind of the full Monty. So I did, not a tremendous amount of fills over here. Again, not a tremendous amount of fills, but what you're looking at is an inflection point spread where I've actually got a 3 contracts actually hedging the sale of a 5 lot of naked strangles. I also went out and actually sold quite a bit of premium inside of the S&P options on futures. Okay, there's an inside hedge here. Looks like I sold a put, sold another strangle. Why would I sell a strangle? Okay, why not sell a call and a put? It's not going to tie up more margin, and doing both simultaneously. Like, listen, just because the puts are jacked up in implied volatility, well, so are the calls. I mean, when the VIX explodes like this, both calls and puts, and I'm telling you, the back month volatility is where it is at. And if you look at my S&P futures, these are options on futures position, I'm like 98 days out. I don't know why. There's phenomenal premium, but there's also phenomenal decay out there that most people, okay, are not aware of. All right, shorting stronger sectors. What do I mean by that? Look, I've got positions. I got positions here, XLU, XLP, okay? TLT, I'm actually technically long in the TLT, thinking it's going to bounce a little bit, but I'm actually shorting. Again, shorting into what has been strong. I'm shorting stuff like Walmart. Walmart. If you haven't looked at Walmart recently, I brought this up quite considerably. Got a short position inside of Walmart. Why? Look how strong that's been. As soon as the market was going to come apart, the correlation was going to hit, it was going to whack Walmart. As soon as the market came apart, what's it going to do to something like XLU? Oh, yeah, that one's looking very, very nice. As soon as the market comes apart, what's it going to do? Just like Walmart, consumer staples, that's one trading session, people. We've got positions in all of those products, and that's something that we've talked about incessantly. We have in-out spreads in those. I'm actually also outright short inside of the XLP. Again, a number of different positions in there. All right. Game face on for Monday. It's serious now. You could actually, we could open futures on Sunday afternoon into an extraordinarily serious situation. You just don't know. After you've had, again, Thursday, which was just an incredible reversal. And I don't mind saying that. When I say an incredible reversal, you got to go back a day and recognize we just came off the 4,500 handle. 4,500 handle. Look where we're trading right now. It's 250 points lower. It's 250 S&P points lower. How long did that take? A day, right? And after, again, even the aftermarket, it's not stopping right now. They're like, make it stop. Okay, it's serious now. You better recognize that you don't just go out and blindly sell options premium without some way, shape, or form mitigating exposure. Okay, I've got a multitude of different accounts over here where I'm actually carrying, again, a number of shorts. And as I said, people want to see exactly what you make or lose in a day like this. Here, this is just the Thinkorswim accounts, which is about 24,000. I also routed a bunch of new positions into the Tastyworks accounts. These are brand new positions. Okay, when I say brand new, again, I'm just executing today into a number of positions, both in spiders and the micro S&P options on futures. This is a big boy trading session. Nevertheless, okay, we open up on Sunday afternoon. This marketplace can get serious and serious in a hurry. If you're going to go out there, you're going to sell premium, you better mitigate risk in some way, shape, or form. Why am I giving you such a harsh warning over here? As I said, volatility to me doesn't look right. If you look at the end of the trading session here, where did we actually end up? Yeah, we're still technically in contango, right? So 28.45 to 28.50. That doesn't make me feel warm and fuzzy. These bonds, I got to be honest, I would have expected them to rally. Yeah, that didn't happen either. We rushed into the dollar because, there's just nowhere else to go right now. But again, It's just nothing on the screen right now screams warm and fuzzy spot. And the last, but definitely not least, something we update you on each and every week. Now, I haven't drawn them on the screen yet. I'm going to draw them on the screen here momentarily. The SPX, the mother of all products. First of all, the SPX is now going into Monday, Tuesday, Wednesday, Friday expirations. They will eventually add the Thursday in just a couple of weeks so that we actually have daily expirations. However, the expected move coming into next week, here it is, people. It's $134 and change. $134. So we just came off of a $98 expected move. We saw the high edge of the expected move, the lower edge of the expected move. We're coming into a full-blown week with a $134 expected move, but we're still under a 30 VIX. Hands and feet inside of the vehicle at all times. The opportunities right now in this dramatic sell-side activity are endless. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.